Hi, welcome. You are joining the first of a recurring series of SaaS roundtables via webinar. We'll wait a few minutes before we start. Thank you for your time this morning. Let a few more come on. Okay. So welcome everyone. My name is Nick Gibbons. I'm a tax partner at Armanino. And this is a first of a recurring monthly series of SaaS roundtables via webinar. First question to the audience: Where is everyone calling from? If you could just in the chat box just state where you're calling from. We got Kansas, thank you, Courtney. SoCal, NYC, wow, everywhere. Okay, Bay Area, Austin, Tampa, Dallas. Excellent. And then another question.
Wow, we've got one from every state, so it seems like.
So far.
There's anyone from Montana?
North Carolina. I'd like to see North Carolina in the house. That's good.
That's fantastic. Well, I think this is going to be worth your time. We have a couple of excellent guests that will be able to share some really good experience in this sub industry, and the topic that we'll be discussing, which is metrics. But before we dive into all of that, I think it makes most sense to, I guess, one more broad audience question would be: what is the biggest challenge facing your business today? And of course, this is only applicable to those that are, in a business. But if you could just type in some examples of what, okay, predicting new revenue, good. Forecasting, revenue forecasting. Great. So, as I said, this is a monthly webinar for SaaS finance professionals to connect with peers in the industry and gain the knowledge they need to be successful, grow their career, grow their company, and achieve their goals. We'll be bringing in experts who have extensive experience working in and building successful SaaS finance orgs. Today is the first of a two-part discussion on SaaS metrics. We'll be covering what SaaS metrics are, how to calculate them, and how they can be used to better understand your business. We do not want to just talk for the next 45 minutes, so please, this is going to be interactive. So just type any and all questions you may have, and we'll use them to guide our discussion accordingly. This webinar is being recorded, and we'll send out the recording to your email box in the next couple of days. That email will also have a link to register for next month's webinar, so keep a lookout. Before introducing our speakers, we wanted to ask everyone here a few questions to better tailor the discussion to who is on the call and how to best zero in on what applicable metrics to focus on. So what is your current ARR, or annual recurring revenue? Under 500K, 500K to 2 million, 2 to 10, 10 to 50, 50 to 200, or over 200? And then the second question is there as well: what is your current CAC, or customer acquisition cost? Yeah, thanks for putting the answers in the chat, but if you could also click on those radio buttons where the answer, where your answer is, that would be also helpful, so we can have a poll. And then 2, what is your current CAC, or customer acquisition cost? Is it under 1,000, 1,000 to 10, 10 to 50? Maybe you don't know, which is fine. which that should be an available answer. If not, just no worries.
People should scroll down in case they are not seeing all the answers.
Yeah, there is a third question too about your current annualized churn rate. And again,
yeah, if you don't know, then that's good too. So
I don't know. If you don't know, that tells us how to tailor the discussion too.
Okay. Wait a little bit. All right, Rob, do we have results?
Yep, I will close it out here. We got a decent amount of people in, so I think good enough to see what our answers are here. Let's take a look. Can you guys see those yet?
Not yet.
There we go.
There we go.
Okay. Interesting. 10 to 50. Okay. 1 to 10. And some I don't knows. Under 10%. Okay. So Mike and Andy, you guys see those results?
Very helpful. Yes. Thanks.
Yeah. Okay, great. Thank you so much, everyone.
We have a good distribution of levels that helps make the conversation richer.
Well, without any further ado, then let's introduce you to our speakers. Very experienced CFOs, Andy Hyde and Mike Virgins. Andy, do you want to first introduce yourself?
Sure. Spent a long time at GE at the beginning of my career, and then worked my way into the whole internet space, first in an internet advertising business, and then as the first CFO at Salesforce.com, pre-revenue through cash flow positive. And then another gentleman came in, Steve Cakebread, came in to take them public. And I've worked in SaaS businesses kind of ever since, so the last 22 years or something, in various constructs of recurring revenue and SaaS businesses. Mike, over to you.
Thanks, Andy. Mike Virgins. I am the practice leader of our strategic finance outsourcing group, where we provide FP&A and metric support for businesses of all types. I'm based here in Silicon Valley, and after spending time in public companies in the internet, eBay and PayPal world, I branched off to become a SaaS CFO of a company here in the Bay Area, and I've been the CFO for various startups, SaaS-based, recurring revenue-based, but also fintech and other industries. And I'm really excited to be here. Hopefully, we can help you figure out where the insights are for you and your business.
Great, thanks, guys. And sorry for butchering your last name, Mike.
No problem. I'm used to it.
So the first question I think we would like to explore is what is the greatest misconception around the SaaS business model? And I'll hand the mic over to Andy.
Yeah, I think we've talked a little bit about this, getting ready for this session. We were saying, there are a lot of things that go on. I think one of the things is, one of the things that I saw as a major misconception was you need a huge ton of cash to get these things going. And it used to be true that you needed a bunch of cash to get these things going. I know we raised a whole lot of money at Salesforce to get the flywheel spinning, and goodness followed. And I think everybody thinks they have to follow that model. I don't know that that's true anymore. There's a lot of alternatives and a lot of alternative choices. Mike, I think you had some insight on like what's changed on that when we were talking.
Yeah, I think that's true. That certainly you can choose to use money to grow, and I think that's the important part and why it's so important to follow metrics. Because without the metrics, you could be investing money and spending money to grow and be doing exactly the right thing, or you could be doing exactly the wrong thing. And so the point being that you can choose to grow at different rates, and that's important for the purposes of really balancing your investment with your ultimate return, or how fast you get bigger. I think that's important. I think the other thing, and I was glad Nick mentioned this, one of the misconceptions is that SaaS is an industry. It's not, and he specifically said it's a business model. And he's right. Anything that is SaaS is another way of saying, when you talk about business models, recurring revenue. And so the important thing to know is that there's a lot of different paths to success. As Andy mentioned, it could be the rate at which you grow. It could be the number of and the types of metrics you look at and what you're expecting to be ideal for that. So hopefully we can help you to understand there's many paths to success, but there are certain rules on how you think about these metrics to make sure you're headed in the right direction.
Yeah, and scoping out, Mike, and you helped me with this. There are two real meta metrics, right? In the long run, there's the lifetime value of the customer over the cost of acquiring the customer, so LTV over CAC. And you had given me a pretty good rule of thumb of what is a good number.
Yeah, I think, and that's right. I think those are two meta metrics, but I think there are also, and Andy and I have talked about this, there are meta metrics for any business, right? How much does it cost you to acquire a customer? And what is that customer worth to you once you have them? I think the need to focus on that in a SaaS business is more intense because there's typically a delay in realizing the revenue from when you spend the money to acquire the customer. You know, there are some universal rules of thumb in SaaS metrics, and I think the LTV to CAC ratio, as Nick mentioned, is one that's pretty inviolate across the different models. Typically, if your lifetime value of a customer is 3 times bigger than your cost to acquire them, you know, given that is that's considered pretty solid. That if you get to top performing companies, you can see LTV to CAC ratios of 5 to 1 or 7 to 1. But if you're not at 3 to 1 right now, that's okay. The question is, are you headed that way? That's the important thing.
And is the CAC or the denominator in this formula, is that finite, or does that also grow? I mean, does that continue in time? Is that sort of, does CAC, I mean, you must, continue to have to spend to keep that customer. Does CAC take into consideration that spend to keep the actual customer in your mind when you think of CAC?
Well, I don't, but there are a lot of ways to think about it, and I don't want to necessarily presume that I understand the exact business models or the variations on the theme that people have. But typically, cost of acquisition, industry-wide, or business model-wide, talks about your salespeople, your marketing costs, the commissions you pay, right, to your salespeople. You can even be more detailed in that and drive toward what I would call fixed or centralized costs, sales management, or if you're in a direct model, it could even be sales enablement. And so the question is there are many different ways to look at it. What makes most sense to you and your business model, and then just be consistent in applying it. Any other ideas there, Andy?
Yeah, I think when it comes right down to it, there's really only, this is fundamentally a mathematical formula. This is an annuity model, right? So you look to, I think it was basic algebra where we learned about annuities and how those work, and you invest a certain amount of money up front, and for that investment, you get a periodic payment back on that investment over time. And as you do that, there is the other element of churn, which is built into the algebraic equation for exponential decay, for those who are interested in the math side of this thing. So when you put that on, and then each customer represents another annuity, so you end up with a series of stacked annuities. And some of those actually grow. So individual customers, we've done this some cohort analysis too on top of it, where you measure what happens. And I remember, this is long enough ago that I'm sure it's okay to share, but in the early days at Salesforce, we were doing, the class of January and the class of February, and we looked at each month's new additions, and the customer base the number of customers would shrink as there was churn, but the overall cohort would grow for about 14 months before the cohort started to decline. So it actually have growth within the cohort, or the class of January would grow. So as you think about the fundamental math behind all of this, and then you work through to some of these other more layered on nuances and analyses that sit on top of the fundamental math, it doesn't hurt to kind of go back to the beginning and say, oh, this is, we talk about long-term value, that is, the spending the money, the customer acquisition cost. And there's no clear definition, there's no GAAP definition of customer acquisition costs. So Mike, your point about being consistent in the measure, whatever things you throw into that bucket of customer acquisition cost, and I think it should be a pretty broad definition, pretty big bucket, but whatever goes in there, should be pretty consistent, or there should be some real clear reason. You can't change that every month and come up with meaningful trends of what's going on. It's very difficult.
So is CAC then your own definition then for your own company, or is it? Is it?
That's a great question, Nick. There's no. It's sitting in there in GAAP and saying this is, this is, look up the definition. It is your own definition to some extent. But Mike was right on when he talked about, it includes sales and marketing costs generally, typically. And, if people are struggling with getting the definition right, we're happy to help with that. If we can be helpful, we've certainly got plenty of examples of people that are doing that.
Great.
One other thing, Nick, my personal bias is to be conservative in doing it, meaning include everything that you think contributes to a sale. If you pulled it out, it would be difficult or more difficult to sell. I think that's important. Your ratios might not look as good as if you pulled things out, but you're not missing anything when you're thinking about it. And the other reason we mentioned also, just real briefly, why Nick called them meta metrics is, for example, lifetime value is one that encapsulates a lot of other metrics, right? So when you think of lifetime value, the question is, how big is the contract when it comes in? How fast does the relationship grow, or does it grow over time with expansions or new products? And then, of course, the question of churn. When you're losing a customer, you are the lifetime value obviously is ending at that point. So that's really important. Just as an example, when I came into my first SaaS company, the cost of acquisition was about $25,000 a customer. We were looking at small businesses that were churning at a rate that was so high, the long-term value was about $25,000. So you look at that LTV to CAC ratio is 1. And we said that we wanted it to be moving toward 3. And so those metrics meant we needed to look at, why were the customers churning? Were we looking at the right value? Were we getting good value out of the spending that we were getting to acquire the customers? Were we going after the right customers for our product? And these are the kinds of conversations that get metrics and metric tracking raised for you.
That's great. And then jumping into another area, if we could sort of explain the differences between the standard calc, modified standard, and custom calculations. Maybe walk through what we mean here. And Mike, Mike. Yes.
Yeah, this is a really simple concept here, but I think it's an important one. Is, as Andy said, there's no GAAP definition for these metrics. That being said, everyone will have an opinion on how you should measure your metrics. Somebody who's investing in your company, who might be buying your company, somebody who is lending you money, what have you. But the most important person's view on what the metrics should be is you, because you know the business better than anyone else. So that's where, you might say, oh, this is the industry standard way of measuring CAC. And you would want to be able to do it that way. But it's your responsibility to educate your stakeholders and say, we measure it this way because this is the best way to, this shows an understanding of our business, or it might just be, this puts us in the best light, right? And you should know both, and you should be able to calculate it the way other people think about it as well. Any other thoughts there, Andy?
Yeah, I think, when we talk about it, we say, throw in all your sales and marketing costs, and that's true. And I think you got closer to kind of defining it when you said it's the things that directly contribute to causing a sale or making a sale possible. So we can, it's so different for different businesses, different companies. It does vary. And if you're going B2B or you're going B2C, there can be a whole bunch of different things that fall into it on direct to consumer stuff that just, that wouldn't be. Social media stuff spend is going to be much bigger, and it's going to be much more significant. So typically, but it's going to kind of be custom to your business. And again, I didn't do this to advertise, but we can help with that. That's one of the things we do is we look at these models and we see a lot of different ones, and we're happy to come in and do what we can to be helpful, to think about your specific situation, whether, and I've seen some comments like, if there's a direct sales model, that's somehow, obviously you want to capture the cost of all your salespeople. If it's a channel model, you want to capture, the commissions you pay to your channel and so on. So it's going to be a little different depending on your specific, who your customers are and your go-to-market approach. But at the end of the day, it's just trying to come up with a set of costs that you can say, if we spend this, at some point we expect that we're going to obtain customers directly from the spend. So even marketing costs are going to drive leads into the funnel, and then we're going to chase those through. I think there's another little subtle thing we haven't talked about yet, which is the delay in spend versus the production of results. So when you spend money to get a customer, it isn't like you spend the money today and you get a customer today. You spend the money today and you get a customer sometime in the future. So there's this notion of trying to attribute those, and people have come up with various thoughts. Again, that's going to vary by business to some extent, but we typically see anywhere from 1 quarter to 2 quarters, in some cases maybe 3 quarters delay. And you can there's a calculation called the magic number, which says you want to have a magic number of 1, which is for every dollar you spend in this quarter, let's say 2 quarters from now you get $1 of new business. And if you're able to do that, if you're able to drive kind of that 1-to-1 ratio, it typically comes in, when you first look at it and measure it, it's typically less than that. And then you go in and you try to adjust and try to drive your marketing and sales spend to be more effective. So you get to that magic number, as it's called, of 1 or better, but it's a simple ratio.
So let's go to one of these questions real time, and thank you for typing in these questions. So David asks, how fast in your mind should a new SaaS offering get to $1 million and a recurring revenue, ACV side? How is CAR viewed versus ARR in today's market?
And
Andy,
by CAR, I hope you mean contracted ARR versus annual recurring revenue. So I hope that's the definition. Yes, okay, yeah, good. Yes. Thank you for confirming that, David, because I've run into that. So for the audience though, what's the difference? So a contracted ARR is, there's a signed contract, but it may not be billable yet. So so the contract term is, they've signed a contract, but they said, you can't bill me for 3 months or 6 months until I'm comfortable that, that this thing works. And this is typical particularly of new startups. And I've seen this concept. The one thing I will say is please make it absolutely clear to investors and everyone that you are measuring these things and that they are different. and keep track of them separately. And it should help you, because I've run into businesses where the CEO has tried to kind of merge those to make people feel more comfortable that they're driving those, and it doesn't make anybody happy. So I think it's good to have those and just make the difference clear. And I don't know that I can tell you what a particular venture person is going to care about, but if I stand back and look at it from their standpoint, obviously ARR is more valuable than contracted ARR because you can bill it and collect it. But a lot of contracted ARR is maybe better than a little bit of ARR, right? So it's going to be situational, but there is certainly, always has been a discount on contracted ARR versus ARR, and maybe that discount is a little higher today given the pressure on valuations and cash, because today it's a lot about this. This market is a lot about cash. We've learned that.
Yeah, and how fast, just going to David's first part of the question, how fast in your mind should a new SaaS offering get to the $1 million mark?
Mike?
Yeah, how fast? I think the answer is, and I say this a bit facetiously, as fast as possible. But at the same time, I think it's important to be looking at the product market fit. And Andy can talk to a little bit about how they experimented and how they learned their way to the right formula for Salesforce. But my view is, again, since there is a delay in what you spend and what comes out the other side, that's why metrics are so important. It's kind of like, my dad was a pilot. It's kind of like flying IVR, instruments only. If you don't really know what's coming, you should be looking at your instruments, which are your metrics. And so do you want to get to SaaS? Do you want to get to 1 million ARR where your cost and your lifetime value is the same? Probably not. So the answer is, once you understand the dynamics and the key metrics of your business, they all fit together, and you have the money in the bank and everything works out, I would say step on the gas. If you're having trouble figuring that out, I would say don't be in a big hurry to get to 1 million if you think it's not going to stick.
Interesting.
That answers the question.
And just one thought that came to my mind as you guys were talking about all of this is, when a company goes and raises revenue, I mean, obviously it's going to be different from potential investor to potential investor, but I would imagine that some of the more sophisticated investors would really test, I think, the CFO or the CEO's knowledge of the universe of metrics. And so I would imagine that'd be important almost to know the whole universe of metrics and why those would be important. Can you speak to some of the tools that could potentially help you in that scenario? Like if you're going and to raise money, what sort of tool would be helpful to you to make sure you don't slip up on a question or show that you don't have full knowledge or full grasp over your company's performance at the time?
I think there's a lot of literature out there, and I think it's just good to spend time with the literature and look through the various terms and definitions that are used. And just search SaaS metrics and you'll see all kinds of literature you can read through. And I would spend time reading through those. I think the thing we talked about coming into this, getting ready to talk to everybody today was one of the things we noticed was the metrics are going to change and evolve over time as your business matures. So as you go through this, at the early stage, you might be just thinking about how do I drive up my ARR, which is one of the recent questions here is like, how do I get, how fast do I get there? It's a lot about it. It's just getting to a certain volume of activity. Sure. And then as you grow, the questions become much more more sophisticated and the metrics become more sophisticated, and you start thinking about other things besides just, getting to $1 million and growing and doing those things. So someone that has a couple $100 million of ARR is thinking about a fairly sophisticated set of metrics, and having a dashboard and seeing, funnel and pipeline and velocity through the pipeline and ramp time for salespeople, and how can I accelerate the ramp time? Is my ramp time getting faster? So there's lots of things that come into the equation as you get more sophisticated. But I think Mike's point was really important, which is you have to figure out early on what is the model and how does it work and how do I have success here? Because I worked with a client recently, last year before, and they were really, really struggling with how do I sell this stuff? I have a few very happy customers who are crazy in love with this product, but I don't seem to be able to have like a formula that I understand that says this is how I add new customers. And the investors board was saying, guys, you have plans to hire 25 salespeople. We can't support that because you can't explain to us how you are driving these, what's the they call it the, turn the crank, but what's the formula by which you add new customers? And I don't think we knew. I think we got closer to it. We were making some progress, but until to what Mike was saying earlier is, we want to spend the money as fast as you can to get to the right things, but not until you know what you're going to spend it on. You know that when you spend it, it will work, and that's why it's important to keep a sharp eye on what's happening with pipeline conversions and so on.
Hey, Nick, I wanted to go back. There was a really great question that I wanted to address that I've had experience with, and it was a question about how should I think about direct sales versus channel? Should I approach the metrics differently? And I think the answer is no. You shouldn't approach them differently, but you have to make sure you understand the implications of the model and how it affects the metrics. So, for example, my first SaaS CFO job, we were selling both direct with a direct sales team and through channels in industry-related channels, not reseller or SIVs, but they were industry-related groups. And so I think the answer is the same. If you think about it at 30,000 feet, obviously you're laying a lot of cement, as we say. You're pouring a lot of cement. You're hiring salespeople. You're driving that. You're incurring more upfront costs. So your CAC is going to be higher. In the reseller, ICV, or the industry market, you are going to have less upfront costs, but you're going to have more development costs. You've got contractual numbers. You're not going to get all of the pie, so your long-term value might be different. You should also think about the fact that what type of customers and when are you using channel versus direct sales is almost more important than the fact that you're using both. The issue I had with indirect channel sales was I was getting a lesser quality of customer, that the revenue was lower and they were churning faster. So my CAC was lower, but my LTV was also lower, right? So I think that's a good example of how you use the same metrics, those same meta metrics, but you think about them differently, and you have to don't underestimate how much support an indirect channel is going to need from you. Don't assume sales and channel support is not a selling cost. It absolutely is if you're doing it correctly.
Interesting.
Yeah, and then there was another one about cohorts and what
I was going to mention
on renewals. So the thing that's a little bit counterintuitive, but it makes sense if you think about it a little bit, is the easiest way to grow is to retain and grow your existing customers. What's the incremental CAC for that? It's nothing to speak of compared to selling a new customer, but your LTV is going to grow. So when you're renewing, the relevant metrics there in my mind are, what's your percentage of conversion? Are people renewing? And if so, which segments of the market are renewing and which ones aren't? This is information for you to know where you're establishing value. At the renewal, it might be a great moment, given your cycle, to be selling add-on services or expansion. So the expansion rate or the net retention, right? Expansions versus renewal cancellations would be a very helpful metric to look at. Or are you able to raise prices? Do people see increasing value when you, by using you not only over the long term, but feel the value is such that they can support price increases? Those are the metrics we always looked at. Any other thoughts, Andy, on that?
Yeah, I think I don't want to spend too much time on this, but one of the things that so just shifting a little bit to another topic that's related is the whole pricing thing. We were talking about this the other day. In an inflationary environment, one of the things that we all have been doing with recurring revenue businesses, whether they be SaaS businesses or other kinds of recurring revenue businesses, we've been trying to get typically longer term contracts and locking in those renewals. And this gets at that same idea of, and you get this, every 3 years, you have this big set of renewals going through the pipe, which is fine. But when you think about pricing today versus when you think about pricing, maybe 9 months ago, it's a different world. Mm-hmm. And with the inflation that's going on across the board, and we're going to see that come through in wages, and a lot of these businesses are 80%, 75% of the cost is payroll and related. So when it's that big, and we're going to see some pressure there, I think, based on everything I see, we're going to see continued pressure on wages. It makes sense to be thinking hard about the question that was asked. Where do we get into pricing and value and renewal pricing particularly? So in the past, where we'd say, look, we'll lock you in at this price for 3 years. Now, maybe it's time to think about locking in price increases. And so if I were out selling today and I were selling a contract, I would try to sell a renewal contract, sort of like the real estate people do. I'm going to give you the special discount today, which is my price, and then I'm going to lock in your price increase will be only 7% each of the next 2 years, only, because normally it'd be 10. I'd make up something and try to lock in price increases today. I'd be thinking hard about those kinds of things in these businesses to try to head off what's coming at us. So just a good point. A thought there for everybody to think about.
Let's look here and see some of the other questions we have on renewals. How do your metrics consider grace periods? Do you restate? Ryan, when he asks. Andy,
So sure. So, do you try to say, well, this is where a customer renews, but they don't renew on time, so they renew after the fact? I don't restate. I just put the renewal in the period that the renewal incurred, and we have a bad month for renewals, and then we have a good month, and maybe it shakes out in the quarterly results or quarter on quarter. Eventually, it shakes out. I don't get if I get a question on it, and I have some clients where we do see this pattern of behavior where we start working on the renewals 3 months ahead of time, and for whatever reason, most of them get done, but for whatever reason, maybe 1 or 2 don't get done on time, and I just report that. I just say, look, here's our number. We didn't make our renewals number for this month, but and it may be the case by the time I'm putting the board package together, we've already renewed it. So I can say, this was renewed subsequent to the month close or whatever. But I don't do that. I don't try to restate anything. But yeah, we do see it in terms of do you forgive a customer, or do you let them get away with stuff? Yeah, sure. It's situational, right? It might be that that's a chance to talk about price and say, well, I'm sorry you didn't get in on time, but I can't give you the 10% discount anymore. I can only give you the 5% discount. So if I'm a salesperson, I'm always looking for that angle too.
Okay, well, why don't we switch to our next polling question? And that is, what do you consider to be the most important SaaS KPI or key performance indicator for your business? ARR, churn, CAC, LTV, contract size, net retention, or other.
It's fun to force people to a single choice, isn't it, Nick?
Yeah, I mean,
a couple more seconds here. We've got 38 out of 49 that have answered. Just a couple more seconds here. Really interested to see what we get.
Feel like we should have the Jeopardy music playing in the background.
All right, I think that's good there. Let's see what we got here.
ARR.
Not too surprising, right?
Yeah, revenue. But then second to that, net retention. Is that not surprising either to you guys?
Yeah, I'm just harking back to the very early days and it's just bringing back some good memories from 20 years ago at Salesforce. You know, we were trying to grow ARR, we knew that, and we were looking at CAC. We actually were measuring it even in those days, and trying to see if it was trending down or where it was trending. But we were very concerned about churn because we had, and I was told the guys this the other day, we had churn. It was 15% per month user churn. Or I think it was maybe actually customer churn, and the user churn was even higher. And we realized that we had a whole go-to-market philosophy that was focused on, and literally in the tagline, marketing tagline we used, which was just sign on. It's $50 a month, no discounting. Here it is. Put your credit card, go, and no implementation, nothing to make it really sticky. And so we flipped the whole go-to-market philosophy around and went to a completely different approach, which was, contract required, commitment, C-level commitment required, implementation required, first quarter at least, maybe first year's cash required up front. And many good things came out of it. The churn started to drop immediately, and we went cash flow positive in about 8 months. So there are some things that you can do when you have enough size and scale. You can start to really to change some things. When you're first starting out, it's just getting the way we approached it was just to get the volume of people in, and then there was this massive churn. The good news for us, I think, that the dumb luck part of it was a lot of the churn happened. People had experienced it, liked it, went somewhere else, and kind of like the virus, it spread, and they went out into these other companies and said, I was working at this other company and they had this thing, Salesforce.com, and it was really useful. And so they went out and got all these salespeople went out and got new jobs and kind of took us with them. So that was the dumb luck part. But now it was all, in history, it was all exactly like we planned, sure. But that's how that one worked out. But you have to. It depends on where you are in the stage of things, which metrics is going to be the most. ARR and the growth in ARR is always going to be a critical component. But other ones, I think, pop up from time to time and become critical if they exceed certain thresholds. So, if churn starts to get to be 15% per month, it's concerning, and you start to pay attention and try to do some root cause analysis. And how do we fix this?
Yes. Mike, any thoughts on
yeah, I do. So to your earlier question about did ARR and net retention, were those the most important ones? Did that surprise me? No, not at all. Didn't. Net retention, because it takes the concept of expansion as well as excuse me, as churn into account. What surprised me, and maybe this is the sign of the times, is that CAC is something that people are is not the most important thing, and I understand that to a certain degree, because money has been so plentiful and investors have been saying grow, grow, grow. We want more revenue. We want more revenue. All your valuations are on a percentage, multiple of revenue. As we all know, the capital markets world is changing and changing as we speak. And typically, as Andy mentioned, in a startup, CAC is something that is important to know because that's the fuel you're putting into the tank to see how far you can go, right? So what I would suggest is it may not be the most important one for you, and that might be right, but I think it's going to become increasingly more important. And I think it should be more important to you as a young company, growing company, than it, even though the capital markets might be telling you something different. The other thing that I would say is, based on some information that Rob gave me on it, he said that 57% of the people said their churn was under 10%. If that's true, congratulations. That is an amazingly low churn number for 57%. For 57% of you to say. And if you're a larger company and you have some experience and under your belt and you're at 10% churn, God bless you, get more money and keep growing. What I'm wondering though by that number is, have people been, especially younger companies, have been through the cycle long enough to know exactly what their churn level is? Mm-hmm. Because that is 10% churn is something you expect at the I'm selling to Fortune 1000 companies, and I have a large contract and I'm providing something that is vital to their value chain. That is a wonderful number. And as I said, if you're getting that number, fantastic. If you're saying that you're not sure exactly what it is, or you haven't been through like a full contract cycle, then I would say watch that number. Any other thoughts, Andy?
Yeah, I think it's important at different phases to be, we talked about this before, I'm just going to say it again, maybe in different words, is, it's important to have a dashboard that works for your business and understand that all of these things are moving. All these things are moving over time. They're evolving over time, and impacted by outside forces and internal execution. And it's important to have a dashboard, and that dashboard itself is going to evolve over time. And it's going to have, as you grow and you're going to have more sophisticated metrics. That's great. We have some examples of dashboards for companies at different stages, and we love, this is something Mike and I we love this stuff, and so having a chance to come in and take a look at the dashboards that you're working with individually. I mean, that's yes, we get paid for doing that work, but it's something that we love. We just love to help companies work through the process and think about, are these the right metrics for today? Great. What are the metrics we're going to need tomorrow? What's that dashboard going to look like? How do we get ready for that? What are the things that are going to happen at the next stage? And as we look at, as I mentioned, there's things around when we get at the larger companies and they start looking at things like velocity through the pipeline, and at the beginning it's conversion rates, right? But then it gets like velocity, because how fast does it move through the pipeline? And these more sophisticated metrics, you can ignore those when you're small, because you don't have enough data to calculate them. It's not meaningful. Have a sample of 3, that isn't a sample. That's there's no real trend there. But as you get larger and you start to see the volume of activity, and you're able to to create some of these more sophisticated metrics around even LTV. If you're just starting out and you have your 2-year-old company, it's really hard to calculate the LTV because you sort of don't know yet.
Right.
But you make some intelligent guesses and you try to do those things. But we building these. At first, it's a simple dashboard, and there's lots of engines out there that can help create some of those. But as you get more sophisticated, some of these other metrics start to really matter as you start to think about it.
Yeah, Mike, you had mentioned that your dad was a pilot, and so I can imagine that the dashboard just keeps getting, more and more, panels and instruments and numbers and things. But as you master those, it is fun. It's got to be very fun, and putting that together, which which dial do you put where, and what are the most important dials? Which dials do you look at daily, hourly, monthly, etc.? So it's
right. Where's your tolerance for movement between those? And if something's moving the wrong way, then you get curious. As Andy was saying earlier, you start diving in, you start analyzing, why is our renewal rate with small companies so low?
mm-hmm.
Or why are we seeing more churn in the enterprise clients than is kind of typical of the range, right? That's where you want to, and it's great to follow a lot of them, but you've got to read them all, and you've got to read them regularly, right? My dad joked that I was the best instrument pilot he'd ever flown with because I couldn't see over the dash. I had to rely on the controls. And to the degree you really rely on those controls and not just look out over the dash and say, well, things look clear to me, then the better off you'll be.
Yeah. R2D2. Looking at some of my directions from Rob here. I appreciate that, Rob. Yeah, one thing just to mention is that, next month we'll be talking about how we collect the data that, that shows us what those rates may be, and how to report them. So that's a plug for next month's roundtable.
I know, Nick, on one quick comment and following up on Mike's thing. We had, when we were back at I keep doing this, but back at Salesforce, we were seeing this churn. Now I got that in my head. We were drilling in on this churn. We're trying to figure it out. What's causing this? And we couldn't get to any commonality. And then I said, let's just run a Boolean search on customer names and have anything that has something like, let's see if we can find some common ground. And what we found out was that there were a whole bunch of real estate companies that somehow had, I don't know how it happened, but there were just all these real estate companies. And apparently at the time there was, there was a real estate, enough of an impact from the kind of the web collapse around 2000, 2001, that it affected a lot of real estate firms. And they were churning out like crazy. And we scratched our heads and said, how in the world did we get real estate customers using, real estate firms using Salesforce as an effective? Why did they think that was a great tool? I don't know exactly how that happened. And then there was another set of people that turned out that had something to do with, computer or tech, or is somehow related to the tech industry, which we kind of expected. So it was, it's like whatever you need to do to drill in, once you see that there's a thing, find all kinds of things there's all kinds of tools to drill in.
Yeah.
Mike, you have a thought on that?
Yeah, I think like I said, you have to be curious. If you're not trying to figure out why your instrument is showing you a reading that's out of range, you might as well not have it. So I think that's a particularly clever way of thinking about it, Andy. But, if you get multiple people all looking at metrics, you'll get some creative ways to dig deeper and figure out why things are out of tolerance, and you'll find the answers. It's a very iterative process. The joke is that in a startup can you figure out the formula before the money runs out? Well, metrics help you figure out the formula. That with curiosity is why Andy and I love talking about metrics. However funny it might seem, because that's how you figure out the formula. And once a formula is figured out, money starts flowing, and that's a beautiful thing.
So there's a question here, Mike, about kind of COGS and what percentage of COGS and stuff. That speaking of things that are worth drilling into.
Yeah.
I don't know what people are experiencing. Maybe people can throw in their COGS and see what they are. If everybody wants to throw up on the chat what they're experiencing as hosting costs or COGS or something as a percent of revenue, it might be kind of interesting to see. And
I think there were some costs there were some questions about hosting costs, Andy, and So my experience, I'll give you my experience. I'm sure Andy's has experiences with this as well. That was the thing that was the most confusing thing for me when I came into SaaS. It's like figuring out the world of AWS or Azure and what should this cost. It really, there are some rules of thumb. It depends on how much computing power you're using. It depends to a certain degree, or how complex your platform is that AWS has to drive. But, a fairly decent rule of thumb is, hey, if you're growing and you're relatively small and your compute power is kind of average, 4 to 5% is not out of once you have some critical mass, whether you have 10, 20 million in ARR, what it would really behoove you to find somebody, if you don't have somebody on your IT teams that understands the pricing, because what AWS and Azure and Microsoft are looking for is if you're willing to commit to certain levels, then and provision that with them, they'll give you a lower rate. So these negotiations are technical and they're financial too. So you would hope that you'd start around 4%, and that percentage would go down over time as you feel more confident about reserving a certain amount no matter what you think your forecast is going to be. That's a radically oversimplified way of thinking about it. Any thoughts there, Andy?
Well, and if it's radically higher than that, I'd be fascinated to learn more and explore with you what's going on. So maybe there's a follow-up conversation. We're happy to take those, right, Rob?
Mm-hmm. Yeah, just interjecting here, just wanted to call out, we're running short on time here, so maybe you guys can just take a quick stab at it. But Blair was the one who asked it. He said theirs is actually at 40%. They're using GCP and our data and compute intensive IT endpoint monitoring. So again, I don't know if we have, within 3 minutes can get to all the intricacies of that, but maybe you guys could just speak to it really quickly. And Blair, maybe if you might want to follow up with Mike
on the range, that's an outlier. So the question is, to what degree is that higher than it needs to be given their compute power needs, versus do we need to think about pricing or value for the offering, given you have to pump money into sales, marketing, and admin, and you're already starting at 60% gross margin, where you might, 75 to 80 is probably more typical. Everybody's business model is different, but that one is an outlier.
And we'd have to look at the specifics, Rob. So I don't know if we can cover that here, because it could be that this is an outlier because there's very little OpEx, and it's all the service is fundamentally the compute that they're providing. So happy to go look at that. But
the bottom line is the most important thing. But if you start at 60% gross margin, you're hoping that your cost of acquisition is pretty low. Otherwise, then you got a challenge there.
Well, great. Yeah. So we're about wrapped up here, Rob, unless there's anything you think we got.
The only thing I'd mention is if Blair, Mike and Andy, or if you guys are okay with Blair, maybe getting in contact with you guys, understanding a little more, talking about what might be able to happen. I'll go ahead and drop your guys' emails in here, so Blair, you can follow up after. But Nick, take it away. Close us out here.
Yeah. So I just want to remind everyone that next month will be about data collection, reporting processes, and then decision making. The link to register will be in the follow-up email. And then if you have the time, please take a few minutes to fill out a post-survey event. We want to hear from you about how we can improve in the future, from format to topic. So this is a series. So this series is always as valuable to you as possible. And thank you and have a great day. I really appreciate your attention and participation.
Thanks, everybody.